You know that feeling when you glance at the news and it just seems like everything is fracturing all at once, from massive friction across critical global shipping lanes to deep divides over new tech regulations to intense climate events battering our infrastructure. Honestly, it can feel completely overwhelming. But as we'll see, it's actually all deeply connected. Okay, let's dive into this. Welcome to today's Explainer, where we're going to break down the massive macro forces that are currently shaping our global reality, and we'll use the latest data to try and make sense of the chaos.
Here is our roadmap for today. First, the global energy choke point. Second, the US-China AI divide. Third, recovery after Hurricane Lala. And finally, global markets under pressure. Let's connect the dots. Starting with Section 1, the global energy choke point. We're zooming out to look at the geopolitical friction in the Middle East that's directly affecting maritime trade. And this situation right here brilliantly illustrates the current geopolitical stalemate. Right now, we have completely contradictory claims over literally one of the most important waterways on Earth. On one side, Washington maintains that the Strait of Hormuz is open, noting the U.S. can sustain a naval blockade of Iranian ports. But on the exact opposite side, Iran declares that the strait remains closed until Washington fulfills the terms of a previous interim agreement. It is a massive standoff.
So what is the immediate physical impact of that standoff? Just 6. That is the total number of commodity vessels that actually crossed the Strait of Hormuz on Tuesday. Now, to put that into perspective, that number was at 9 on Monday, and the recent daily average was 11. So because major ship owners are avoiding the route due to military and insurance risks, we're watching a massive bottleneck happen in real time.
And the regional developments surrounding this choke point? They're moving incredibly fast. The United Arab Emirates recently detected 2 ballistic missiles that landed in the sea, which reportedly targeted maritime traffic. In response to that, Abu Dhabi actually suspended trade and financial transactions with Iran. Iran, for its part, swiftly denied launching the missiles, calling the accusation entirely baseless. Meanwhile, Saudi Arabia has just resumed limited oil loadings inside Hormuz after suspending them for 3 weeks. It's a highly volatile, highly complex situation.
So how does this geopolitical friction translate to the real world? Well, it hits the energy markets directly. Because of these prolonged shipping disruptions, oil just reached a 3-week high. Brent crude climbed to $91.79 a barrel, and West Texas Intermediate advanced to $85.79. Analysts are even warning that Brent crude could return to triple digits if these regional supply disruptions get worse.
Which brings us to the so what? Why does this actually matter to you? Well, a blocked strait thousands of miles away doesn't just stay in the Middle East. It travels directly to your wallet. Higher oil and gasoline costs mean you're paying more at the pump. And, as our source material notes, this economic reality is directly increasing political pressure on the administration right before the November midterm elections. Geopolitics always hits home, doesn't it?
Let's move to Section 2 and see how this builds into our next major macro force, the US-China AI divide, or the technological Cold War.
Just wrap your head around this number to understand the sheer explosive enthusiasm in the tech market right now, 8,000. During the public market debut of China's Unitree Robotics, retail demand exceeded available shares by an astounding 8,000 times. I mean, the stock surged approximately 600%. There is an absolute frenzy around practical AI and robotics applications right now, and the competition to dominate this space is absolutely fierce.
But the way the 2 major superpowers are playing the game is completely different. On the American side, the strategy involves geopolitical maneuvering. Washington is preparing an AI coalition that would actually require partner countries to choose between American frameworks and competing Chinese ones. On the Chinese side, companies like DeepSeek are taking an aggressive commercial approach. They're using significantly lower inference prices, which basically means it costs much less to actually run their AI models, to put immense pressure on American and European providers.
So, what we're witnessing is the actual fracturing of the global tech market. National rules are dividing everything from AI models and microchips to platforms and data storage. Want a perfect example of this division in action? Take Apple. Apple is currently training an entirely separate internal AI model just for China, simply to meet local regulatory and commercial requirements. We're really no longer looking at one global internet or one global tech standard.
And the intersections here get incredibly complex. For instance, federal regulators just approved a bank charter for the Trump-backed cryptocurrency company World Liberty Financial.
But here's what's fascinating. This same company is supporting a venture called WorldClaw that uses crypto tokens to offer access to AI models developed by Chinese companies that Washington has actually identified as security concerns. It is a stunning entanglement of American politics, decentralized finance, and restricted artificial intelligence.
All right, let's pivot from the digital world back to the physical one. Section 3, Recovery After Hurricane Lola, looking at climate realities and tech interventions. You know, we often talk about climate events in the abstract, but the aftermath is deeply operational. In Hawaii, navigating the destruction of Hurricane Lola means actively working through strict recovery phases. First, utilities are battling to restore electricity to over 180,000 customers who lost power. Second, health officials are having to closely monitor lingering floodwaters for dangerous sewage, chemicals, and disease risks. And third, they are relying heavily on Earth observation satellites to assess exactly which infrastructure is damaged and which roads are blocked.
And this is where the narrative loops back on itself in a really fascinating way. The very same advanced technologies that are currently dividing nations, AI, satellites, advanced sensors, are the exact tools actively being used to coordinate complex disaster recovery. We've got satellites tracking storm runoffs over hardened lava surfaces. We have automated sky surveys using AI to map unusual events in massive data sets. And researchers are combining radar and ground sensors to vastly improve future coastal flood warnings. It's a bit ironic when you think about it, right? Tech is currently the global battleground, but locally is the ultimate lifeline.
And Lala isn't happening in a vacuum. While Hawaii recovers, extreme heat continues to persist across the U.S. mainland. The South and Mid-Atlantic are facing dangerous conditions with very little overnight relief, posing severe risks to older adults, outdoor workers, and folks without reliable cooling. These are compounding, simultaneous national climate events that are really stretching resources thin.
So the crucial point is this. All of this friction, whether it's delayed cargo ships, massive AI races, or disaster recovery, it all costs money. Which brings us to our final section, global markets under pressure.
$1.09 trillion. That is the amount of future data center lease commitments that big technology companies have currently accumulated. Just to fuel this AI race and secure limited supplies of electricity and land, companies are locking themselves into over $1 trillion of future financial obligations. The scale of capital being deployed here is literally historic.
But while tech is booming, the broader economic pressures are mounting rapidly. Global friction is driving up costs everywhere. We're staring down looming 50% American tariffs on designated Canadian imports that are set to begin Wednesday unless a last-minute deal is struck. Meanwhile, borrowing costs are incredibly high. The 30-year U.S. Treasury yield is hovering near multi-decade highs around 5.27%. And to keep the lights on, the Treasury is preparing to sell $16 billion in 20-year government bonds.
So why the massive government bond sale? $40 trillion. That is the stark reality of the approaching national debt threshold. Government borrowing just continues to rise steadily as we try to navigate and fund responses to all of these compounding global macro forces.
And that brings us perfectly full circle. As our source explicitly notes, higher oil, gasoline, and borrowing costs are increasing political pressure on the administration before the November midterm elections. The geopolitical friction in the Middle East, the multi-trillion-dollar tech Cold War, the billion-dollar disaster recoveries, they all eventually trickle down to the cost of borrowing $1 or buying a gallon of gas. And that economic friction, it inevitably turns into political friction.
We've covered a lot of ground today. We've looked at fractured shipping lanes, divided artificial intelligence models, extreme weather recoveries, and a deeply pressured global economy. It's like a giant puzzle. All of these forces are interconnected, and all of them are shifting beneath our feet right now. So I'll leave you with this final thought to chew on. With global trade, technology, and climate under such immense pressure, which of these dominoes is going to fall next? Thank you so much for learning with me today. Keep asking questions, keep looking at the data, and I'll catch you in the next explainer.